Hello students, welcome to Chapter 3. We're going to be looking at the accounting equation and the double entry system in this particular week's content. So we've reached week 4. We're going to be focusing on pages 36 to 49. I'm going to be covering all the theory so that you'll have a really good idea of how to approach the accounting equation and double entry. The textbook has provided you with many different activities, so please try to complete as many of them as possible. And then when we have our live sessions and on-campus workshops, please bring your questions and topics that you might be struggling with, and we can go through them in more detail. To start off with, we have an introduction. In this chapter, you're going to be looking at the reason why accounting has become known as the language of business. We've described that already. We know accounting is used to convey financial information to users so that users can make decisions with that information. So as we delve into the intricacies of the accounting equation, which is basically outlining the financial information, but on a transaction by transaction basis, you're going to discover how the accounting equation can be used in everyday life. It's a very important skill because if you can interpret transactions correctly and you know what the effect is going to be on the various accounting elements, it's important to know what the actual consequences are of all the decisions that can be made in a particular business. So just keep that in mind. Remember the big picture. The big picture is about creating value. And if we're going to be creating value, we obviously need to make good decisions that will help the business improve, grow, and become more successful. Just to outline what you're going to be required to do after having completed this particular chapter. Make sure you're able to analyze transactions under the accounting equation. Can you define assets, both non-current and current? Can you define liabilities, both non-current and current? Can you explain what a proprietary account is? Do you know what expenses and income accounts are? And then obviously discussing the profit motive. What is profit? How is it calculated? And obviously what the differences are between gross profit and net profit. And then finally, can you apply the rules of the double entry? So there's a lot. Chapter 3 is the longest chapter. It has the most content as well as the most practical workings and calculations. So please just consider that as you go through the content in this particular textbook chapter. All right, the first thing we need to look at is the accounting equation and what exactly is the accounting equation. Well, just to write it down, accounting equation, A equals O plus L. Right, that's the simplest way of writing the accounting equation. You can obviously rearrange those values and you can make O the subject or L the subject. If you make O the subject, then you'll have what the textbook has provided you here with. The business's worth, which is the owner's equity, so O, is equal to the business's assets minus the business's liabilities, A minus L. And if you wanted to, you could also look at L as being A minus O. Okay, assets minus owner's equity will give you the liabilities. So just remember that when looking at different types of businesses or even individuals, for example, Andrew owns a house that's worth $1 million. And he has a mortgage on his house, which is an outstanding loan of $400,000. What would his worth or wealth be? Well, obviously you would have to take the owner's equity formula, O equals A minus L, and you would subtract 400,000 from 1 million, gives you net worth of 600,000. So just remember, if assets are greater than liabilities, that's good. Ideally, you'd want your assets to be more than your liabilities because that shows that you have net worth, right? There's wealth within the organization. Right, so that's very important to understand. That is the accounting equation, and we're obviously going to be using it in different areas as we continue progressing through this particular chapter. The first thing we need to establish is an asset and what defines an asset, what makes an asset an asset. So the first accounting element that you've been introduced to is an asset. So you should have a pretty good idea of what constitutes an asset from maybe some of the assets that you've got. Okay, so some of you might have maybe a vehicle that would be considered an asset. Maybe some of you have a home, okay, a house, property that would be considered an asset. Maybe you have machinery that would be considered an asset. Equipment would be considered an asset. Maybe some of you have, let's think about inventory. That would be considered an asset. Maybe you have debtors, something we've seen before. That would be considered an asset. So when looking at assets, there are many different types of assets, but they all meet the formal definition. And this definition obviously comes out of IFRS. So the definition of an asset is as follows. An asset is the present resource, okay, controlled by the business as a result of past events. Okay, so think of it like an object. Okay, it's an object that you possess. It's a possession. It's something that you own. The best way of describing it would be a resource. Assets are resources, and they're controlled by the business, and they give rise to future economic benefit. In other words, they can do more for us in the future. They provide us with something in return. Okay, so assets that are good will generate income. For example, savings and investments generate income in the form of interest and dividends. Okay, maybe you have property and you're renting it out. That provides you with rental income. Maybe you have a business and you have machinery and equipment and you're producing products, and those products are sold at a profit. Inventory can be sold. Debtors will obviously pay you in the future because they owe you. So just remember that assets have a very specific definition. Make sure you study this page. But remember, this textbook is yours, so please don't be afraid to highlight, circle, underline, make notes in your textbook so you have all the information that you need. There are some examples here which the textbook has provided you with. They talk about vehicles. Okay, the vehicle is the asset. Right? Yes, you might have taken out a loan to buy the vehicle, but then that's something completely different. Okay, we're not looking at the loan, we're looking at the vehicle. When you bring in a double entry, now you're looking at the financing. So how did you buy the vehicle? That's something that you could consider. Another asset could be bank. Straightforward, simple, cash. Right, bank is an asset. If you have money in the bank, it's an asset. If you have cash float, petty cash, whatever the cash is, whatever form the cash is in, it's all considered an asset. If you don't know what different assets are, you can just study a list, that's fine, and the list would entail identifying the different types of assets that you could possibly get. So when you look at non-current assets are long-term assets. Non-current means long-term. Okay, then you get current assets, which are short-term. Okay, the opposite. Right, so land and buildings, plant and machinery, equipment, financial assets such as money market accounts, shares, unit trusts, whatever it is. Okay, obviously you can, let's say, classify assets into different categories. So you can talk about equipment more broadly, or you can break it down into computer equipment or office equipment. Maybe you could even include furniture as part of equipment. It all depends. Right, but just remember, each and every one of these assets meet the definition that we saw at the top. Okay, so there's the note about non-current and current. The one is long-term and the one is short-term. Okay, what is long-term and short-term? Well, non-current would be long-term, so greater than 12 months. Current assets are short-term, less than 12 months. And that's what you're looking at in terms of duration. Okay, so during the year or after or longer than the year. You also get intangible assets. Intangible assets, if something is intangible, it's not a physical asset. You can't see it, you can't touch it. All of these assets I can see and touch. Land, buildings, plant, machinery, equipment. Okay, those are things that I can see and I can touch. Okay, they're long term. If they're intangible, then these things would be like copyrights, patents, goodwill, trademarks, okay, websites. Right, these are all intangible assets. Things that businesses or individuals can own as resources that are assets, but they're intangible. Right, so please just take note. We're obviously going to be focusing on tangible assets. So tangible means physical assets, land, buildings, plant, machinery, equipment, vehicles. Those are the type of assets we're going to be looking at. Here's a list of current assets. So again, you need to understand definitions and you need to be able to differentiate between what is a long-term asset and what is a short-term asset. If I've got a current asset, I'm dealing with things like inventory. That's a short-term asset because I'm going to be selling it. I'm going to be selling it during the year, maybe daily, weekly, monthly, depending on how quickly you get to sell your particular product. Debtors, also a current asset. Cash in the bank is a current asset. Petty cash is a current asset. Petty cash is money used to pay for small amounts, okay, small items, small expenses. Cash float is money kept in the cash register to give change to customers. You also get a few other considerations. We haven't looked at VAT yet, but you will. VAT is also considered a current asset. And the reason for that is you get to claim, okay, you get to claim input VAT from SARS. But you won't know too much about VAT yet until we've covered that particular chapter. For now, just appreciate that you have a list of accounts, and these are current, which are short-term assets. There are 2 activities here which I'm going to encourage all of you to please complete. We will discuss and look at them either in the live workshop or on the live Zoom session. So please have a look at these 2 activities and see if you'd be able to complete them. They're focusing mainly on types of accounts. Okay, would you be able to define what type of account you're dealing with from an accounting perspective? Remember, that's the language of doing business. Now we've reached the definition of a liability. Same as before, we need to understand what we're dealing with. So what makes a liability a liability? Well, here's the definition. Make sure you study it, make sure you know it well. Liabilities are debts. They represent the business's obligation. That's a key word. Obligation means I have to pay it. I have to pay it off. I have to meet my obligation. I have to meet my requirements in terms of the loan. Okay, so if you've got a loan, whatever the loan is, okay, obviously that's considered debt. You have an obligation, okay, a duty to pay it off. And that obviously arose, okay, from a past event. And when you actually meet the obligation, there's going to be an outflow of economic benefits. Okay, obviously I'm going to be using cash potentially to pay back the loan. Right, so there's going to be a future outflow because liabilities must be paid back. Okay, so outflow of economic benefits. Then we've got a few considerations here in terms of timing again. Non-current, long-term. Short-term, current. So you get long-term assets and you get long-term liabilities. You get short-term assets and you also get short-term liabilities. So just remember that the distinction in terms of timing, non-current and current, only applies to assets and liabilities. Again, if you're looking at studying a list of accounts, which is possible, but it's better to just apply the definition. Okay, so what makes a mortgage a liability? Well, I owe the bank. The bank needs to be paid. There's an obligation to pay the bank. There's a liability. So a mortgage loan would be a non-current liability. Bank loans can also be non-current if they're maturing greater than a year. So in other words, if you have to pay back the loan after 12 months, not before, then that would be considered a non-current liability. A few current liabilities: bank overdraft. Okay, so when your account is overdrawn. Creditors, when you buy from a supplier and you owe the supplier. In other words, you have to pay them back. You have a creditor. Okay, you owe them. SARS could also be a liability because you have to pay taxes over to SARS. You might have to pay VAT over to SARS. The VAT that we pay to SARS is output VAT. Again, we haven't looked at it yet. You will look at it when we cover the VAT chapter. Okay, there's a definition here of a supplier. A supplier is just someone who's going to provide you with goods or services. Notice, you're the one buying. Okay, you're buying those goods or you're buying those services. Please have a look at activity 3C. We will go through it in a live session, either on campus or on live Zoom. Here's another activity looking at categories: non-current assets, current assets, non-current liabilities, and current liabilities. Would you be able to identify all the non-current and current? Can you differentiate between the assets and the liabilities? Remember, once you've got the assets and liabilities, then you can work out the owner's equity. We know owner's equity, which is O equals, or OE equals A minus L. So once you've worked out all the assets, in other words, total assets, And once you've worked out all the liabilities, you should be able to calculate it. Right, please try that and see if you can complete that exercise before you continue with more of the content. Right, this concludes part 1. I do need to keep the video shorter, obviously because of Boston Media House's requirement to upload videos onto Cole Campus. So see you in part 2.